Hi everyone, welcome to the latest episode of Market Perspective. I have with me Mr. Ashish Ranawade, Head of Products and Investment Advisory, Emkay Wealth. Hi Ashish sir.
Hi.
How are you doing?
Wonderful.
Great. Shall we jump into the interview?
Absolutely.
Yes. So we had a phenomenal last year, a very steady bull run. So do you think, what's your outlook for this year?
So clearly Indian markets are expensive at this point in time. I think the valuations have run ahead a little bit as far as fundamentals are concerned. But then, what investors are seeing is that when you look across the globe, India is one of the fastest growing economies. And also with the initiatives being taken by the government, there is a lot of growth which is coming up, especially in infrastructure and capital goods. There's a lot of investments coming into India, in especially manufacturing, defense, railways, and I think a lot of that has caught the attention of investors. Number one, and also the fact that there's a lot of money, domestic money, which is coming into the Indian markets ever since COVID happened. The flow of money into the Indian capital markets has been quite significant, and I think both these things are very healthy from Indian markets perspective. So from that perspective, we've already had a fantastic run in the last broadly 3 years. I think going forward the markets should be in a consolidation mode, clearly because the valuations are expensive at this point in time, and there will be opportunities, specific opportunities. We have a very deep market. There are more than 3,500 listed companies, and the growth is percolating down to even the smallest companies. So especially if you look at the last 1 year, the performance of micro caps and nano caps has been exceptional. The Emerge platform is showing a great amount of vibrancy. So having said that, there will be opportunities for investors who are a little adventurous and who want to look beyond the top 500 companies. I think there are plenty of opportunities in the next 2 to 3 years because I think the tailwind as far as Indian markets is going to be very strong. So my message to investors is that you continue to look at equities. There are opportunities, but do not expect that the market as a whole will perform. So the opportunities are going to be very specific, and I think a seasoned fund manager, an astute fund manager, will find these opportunities and should be able to outperform. So I think it's our job to help you find the right fund manager, and I think at Wealth, our Wealth team is doing exactly that, and we've been doing that across different market conditions. So that's where we are as far as the next this calendar year is concerned.
That's great. Next question would be, how is the investment landscape? Which products do you think will make the most of the bull wave?
So specific opportunities at this point in time, if I were to look at, as I said, growth is expensive. Growth stocks have run ahead in terms of their valuations. But as a philosophy, I think one should start looking at value. Also, an offshoot of value, I would say, would be PSUs. PSU stocks have been trading cheap for a very, very long period of time, and last 1 year they've done exceptionally well. But that's what happens when the value unlocking starts. So PSU is a theme which is an offshoot of value which one can look at. There are a lot of manufacturing related opportunities, and especially the PLI incentives that the government is giving, defense, railways, many of these segments offer a lot of opportunities as far as investments are concerned.
You would say that PSU's run have just started and there's a lot more to go.
Well, let's hope so.
We all are. So, in your interview in HT Mint last year, you had indicated that US stocks like advanced materials, space technologies, nanotechnology, biotech would do well. Are you still bullish on these trends?
So last year, many of the US stocks were hammered. I mean, I remember Netflix used to trade at $225. And I think at that level, those kind of valuations those kind of stocks at that valuation were looking extremely attractive. That's why we gave out the call to target the top, 20 or top 30 themes as far as US is concerned. And those have played out really well. In the last 1 year, I think Netflix has doubled. Many of Meta has gone up like 3 or 4 times. And the FANG stocks have done extremely well, and I think one needs to look beyond these stocks now, because what has recovered in the US markets are these stocks, but the broader market is still continues to be down. And if I may just throw names, companies like media companies like Walt Disney, consumer companies like Estee Lauder, which continue to be in the bear grip. And I think the valuations there are very, very attractive. There's manufacturing companies like 3M, Stanley Black & Decker. I mean, just to throw some names, these are trading at, 5-year, 6-year lows. So, and clearly the reason for this is that, the interest rates are high, and there is some amount, and US is very interest rate sensitive market. So also not just the economy is interest rate sensitive, but the fund managers are also seem to be interest rate sensitive, which is why they are kind of, dumping these kind of stocks. But I think these companies have been around for hundreds of years, and I think going forward, these are the kind of companies I would look for. So US continues to be attractive to me because, the big move in US will happen when the Fed pivots and interest rates start moving down.
Great to see that your instincts played out well. So that's good news for your clients as well.
Thanks.
So what new trends do you think will emerge in 2024 or have emerged in 2024?
So as I said, in the US market, these are the opportunities that we are seeing. In the Indian market specifically, I also said that, PSU as a trend is just starting to emerge, and, it can have many legs going forward. Manufacturing as a theme, again, is a very, very interesting theme. From investors' point of view, one new area which is emerging is algo trading. And a lot of our investors, I am seeing that, they are in some form or the other trading the markets using, AI, ML, and these kind of techniques. And I think that could be a big trend going forward, because what I believe is, these algorithms play on volatility. And if the market's going to be flat, it basically means it's going to be volatile. It's going to move within a certain range. And I think that is what drives these algorithms. So, that I think if I have to identify a big trend in the market, I think that would be it.
So, gold has not had much shine, neither has crude shown some flow. So, how would you advise investors on these for their portfolio?
See, gold, the way we look at gold is as a proxy for fixed income. And if you see the performance of gold, last 5 years it's done 12%. Last 3 years it's done 9%. And last year it's done 7.5% to 8%. So, it's done definitely better than fixed income. And I'm talking of, gold, if you look at gold bonds, which the RBI comes out with, you get an additional 2.5% interest on that. So I think from that perspective, gold has done very well, and no reason why it should not continue to do well. So I would, we advise our investors to have at least 10 to 15% of their investable portfolio, aside of all the gold jewelry and stuff that they have, in their households. For a simple reason that gold has the potential to outperform fixed income, and everybody has a fixed income allocation. So, gold can be a proxy for that fixed income allocation, and it will do better.
So it totally depends on which form of goals you have.
I think the sovereign gold bonds of RBI are the
Phenomenal.
best way to
I agree with you.
hold gold.
Any thematic funds which are on your watch list for the growth portfolio?
From a thematic perspective, as I mentioned, PSU as a theme looks attractive at this point in time. Manufacturing as a theme looks attractive, and there are overseas funds that are existing in India. I don't know what's the situation at this point in time, but there's always a SEBI cap, RBI SEBI cap in terms of how much these funds can actually invest abroad. That's a big deterrent, but also the taxation is a big deterrent, because for these funds, it's your marginal rate of taxation which applies when you sell them. So barring all these, if you're not too particularly worried about these things, then overseas also can be a good theme. So that's broadly the three themes that we are looking at, and I think at some point in time, between now and let's say the next year, the Fed is going to pivot and interest rates are going to drop. They may not drop very sharply, but they will start trending downwards. And when that happens, the longest duration fund that you have in your portfolio, or the longest duration bond that you have in your portfolio, that's going to appreciate in value. So I think an SIP into a long duration debt fund can be a good investment opportunity, especially over the next 1 year.
So you have been monitoring investments, portfolios, and growth of several clients. What is their view on the markets? How have the portfolio returns been so far in FY24?
Oh, the portfolio returns last year have been fantastic. Equities have delivered more than 30 odd percent, and in fact some of the funds have delivered more than 50% returns. Fixed income has delivered, which is actually the worst performing asset. They have delivered somewhere around 7% returns. Gold, as I said, has delivered 8% plus. Real estate has done very well, and even overseas funds have delivered more than 13% odd returns. So I think broadly clients are happy with the performance of their portfolios last 1 year, and that kind of sets them up very well for the coming year as well, because now the expectations as far as returns are concerned are not that very high, because everybody, the mature investors do realize that this is something which is not going to continue forever, so they're ready for a consolidation in the market. So the expectations now this year are not that very high from the portfolios.
It's interesting that you mentioned matured investors who understand the markets. My next question would be piggybacking on that. So as the Gen Z takes over mantle of investments from their previous generation, how do you advise them to approach the same?
I think the current generation understands certain aspects much better than the older generation. Like when we came into the markets, right? Those days, computers were kind of not existent. And I remember when I used to interact with my father, I had to kind of explain how to use a computer to him. And I think the new generation now that's coming up, they are going to teach us machine learning and artificial intelligence and a whole lot of that stuff, which as investors we are going to find it difficult to apply. I mean, I remember when the information technology age was happening. Warren Buffett, who's the most, I would say, successful investor, kind of said, I don't understand what's happening, in this space. So he didn't invest. But then eventually he did go on and bought a lot of tech stocks. So I think Gen Z is probably going to catch many of these emerging concepts much faster, and I think they should be able to make good money in that emerging areas. But at the same time, as industries mature, they would also kind of need to learn how to make money the old-fashioned way. I think that blend would be something which they would benefit from.
So, in short, they should approach seasoned wealth managers like you guys?
Absolutely.
That's great to know. So that's it for our this episode of Markets Perspective. Thank you very much for your insights.
Thank you.